Can you tell us more about the steps involved in developing a system? So if you're making a hypothesis and then trading in it, how do people set up these systems?
There are two approaches. One approach is to make a hypothesis about the market. So we talked about indicators before. So a simple example would be, let's look at the currency pair. Let's put the Bollinger Band around it, which is maybe 2 or 3 standard deviations away, and let's postulate that every time price goes above it, it has a tendency to come back. And so we test that on this currency pair, it looks great. We test on another currency, it looks great. Actually, it does look great, and so I urge people to have a look at that. And it's consistent, doesn't do that many trades, but over time, it makes money. So, and this would be on a 5-monthly time horizon. So that's one way to approach it. Another way to approach it, which is typically what I tend to do, is to say, well, a trading system, an approach like this, Bollinger Bands, exploits something in the market. And what is it that it exploits? It exploits the mean reversion feature in the market. So that means that I need to be able to have a way of measuring mean reversion. So what I will actually typically do, and that's slightly more technical and advanced, I will create random time series that have that feature embedded, and then apply my systems to these things to see that indeed, as I expect, these systems exploit that particular feature. Once I'm happy that the trading systems I've constructed exploit the feature because it's a controlled test environment, I can then go to the market and ask myself, well, how it's the best way of detecting that feature, of having a strength indicator on that feature, and then I know how to dial up that particular system in that particular environment. So an interesting case would be mean reverting currencies intra-week. So that can be profitable and churns money on a consistent basis. Now, you do get situations, as we said, because it's that kind of profile where it makes steady money, it can go off a cliff. So the first question to ask yourself is, what kind of regime am I in that'll cause me to go off a cliff in these kinds of intra-week scenarios? And going through everything, it just ultimately turned out it was central bank announcements. Central bank announcements have this habit when they really come from nowhere in terms of policy shifts and expectations to shift currencies dramatically. And the easiest way to therefore prevent a lot of headaches using these kinds of things was to just shut down everything prior to central banks and then switch everything back on after, and then just avoid this kind of headache and nightmare. And that was, again, it wasn't about I need to make the system work. It was about under what conditions will it work? And what are the conditions right now in the market?
So can you take a trading system off the internet and use it to trade?
I think the answer is yes. So I need to qualify that. A lot of the stuff you'll find on the internet is about these kinds of indicators that'll give you a bias. So, and a lot of these things will contain nuggets of truth. I mean, the fact that currencies gap or mean revert over the weekend is a well-known fact. Things like London breakout strategies are well documented on the internet. Carry strategies are well documented on the internet. A lot of it is nothing new. There's no point in reinventing the wheel. The one thing that probably these strategies don't do is they don't manage the leverage and the position sizes according to your own personality. Moreover, they're sold to you as a black box system where you can't tinker with it on the inside and really poke the box. And so what that then creates is a situation where you have a personal preference in one way, but this thing is so rigid you can't change it. So therefore, what I urge people to do is look on the internet, buy these systems, have a look at them, poke them, and take the best features out. Because guess what? There's this big complaint. If I have developed a system, why would I not trade it for myself? And that's a wonderful question to ask. And that shows that people have no clue about business. I'll go back to Buffett, actually, because we mentioned that at the beginning. So Buffett started his first partnership in the 50s with $10,000, and by the time he ultimately liquidated everything, he had $25 million. So that was in the 60s. So let's say from the 60s until now, Buffett truly would have only done what he usually does, is buy Coca-Cola and holds it in Washington Post and just blue chip stocks. Do you really think he would have parlayed $25 million into 60 billion? I mean, think about that. That's something like 2,000 folded his money. What, buying stocks? He bought Geico. Geico was a cash cow. Geico spit so much money out in terms of free float on premium he doesn't have to pay out, that he, as Charlie Munger said, was drowned in income. He had a business where cash was coming in that he could then invest. So not only was he compounding his trading, he was constantly reinvesting. So people who sell systems yes, they probably, the systems are good, trade them, but they're also looking to get income on board, because it's only the combination of income plus compounding and compounding the income that'll take you to the stratosphere. And a lot of people just don't seem to understand that. And so therefore, there are a lot of good things out there, but you have to acquire them, test them, poke them, and look at them. And there's no need to reinvent the wheel. Otherwise, a lot of people, the majority of people aren't Einstein.